In 2008, the financial crisis exposed startling inequities in the global debt system. The average American household now carries over $100,000 in total debt. This financial burden enriches banks and the ultra-wealthy through calculated interest-driven profits. Major institutions long recognized how debt secures a continuous revenue stream for lenders. Consumers, on the other hand, face lifelong payments with little hope of reprieve. This documentary investigates why debt feels inescapable and how it emerged as a systemic tool. The triggering factors of spiraling debts are manifold. Exploring them reveals an intricate web of policies and practices. Bankers knew very well the potential for profit in consumer lending. Their strategies were both innovative and merciless. A shift in how society views borrowing and lending enabled this transformation. Debt wasn't always such a formidable force in people's lives. The seeds for this situation were sown many decades prior. The precondition for this debt surge was a cultural shift toward borrowing as a norm. Capitalism's expansion accelerated consumer credit systems during the 20th century. Financial institutions pushed credit lines, appealing to the growing middle class. Education, meanwhile, lagged in providing vital financial literacy to the populace. The precondition also entailed regulatory leniency on terms of credit and interest fees. Subtle encouragement of borrowing laid the groundwork for today's debt landscape. In the 1980s, deregulation allowed banks greater latitude in setting interest rates. This created preconditions where debt would surge unchecked. The system was primed for exploitation by those who understood its mechanisms. Popular media romanticized consumerism, further compounding the problem. Thus, a culture of debt began to take root. The origins trace back to when credit became increasingly accessible and marketed. Credit cards emerged in the late 20th century, revolutionizing personal finance. Corporate entities like Visa and MasterCard capitalized on this shift. Student loans became widespread, a necessity for higher education that burdened graduates. The origins of home mortgages, once rare, grew mainstream by mid-century. Auto loans followed as vehicle ownership soared in the post-war boom. Payday loans filled gaps for immediate funds, despite exorbitant rates. Banks offered these products widely, feeding into a cycle of dependency. The creation of these tools was initially heralded as progress. Now, they are central to understanding why debt entraps so many. Through these origins, we see the construction of an intricate financial edifice. The promise of easy money led to unforeseen consequences. By the late 20th century, Americans quickly adopted consumer credit tools. Credit cards became a staple of household finance. Student debt soared, with $1.7 trillion owed today, largely non-dischargeable. Home ownership dreams perpetuated through 30-year mortgages, despite hefty interest. Credit became indispensable for living beyond one's means. Auto loans funded the American dream of mobility, yet left owners with depreciating assets. For many, payday loans represented quick fixes that deepened financial woes. Early adoption spread rapidly due to aggressive marketing and cultural acceptance. Debt seemed manageable, almost invisible in daily transactions. The reality struck only when repayment obligations became impossible to ignore. Adopting credit was easy. Escaping its grasp has proved difficult. Debt's mechanism operates smoothly through compound interest and strict terms. Interest rates and fees ensure perpetual income for lenders. Student loans lock borrowers in, with payments spanning decades. Credit cards wield 20-30% APRs, where minimum payments prolong debt indefinitely. Mortgages give banks ownership stakes in family homes. Meanwhile, vehicle loans carry high interest on ever-depreciating assets. Payday loans exploit the vulnerable with rates over 400% APR. Refinancing and debt consolidation mask the continual growth of principal balances. The mechanism exploits consumer psychology, leveraging buyers' misconceptions about credit. Borrowing becomes habitual, embedding into monthly budgeting as a necessity. The financial system reinforces these mechanics, producing predictable lender profits. Anticipation of endless payments fuels societal stress. The system accelerated in complexity and reach as the 21st century unfolded. Bank expansions increased, penetrating deeper into personal finances. Debt's acceleration saw financial products branded as essential consumer commodities. Marketing portrayed credit as power and convenience, encouraging more borrowing. Bank mergers created behemoth institutions with massive lending portfolios. Debt products became intricate, with variable rates and complex terms. The acceleration was fueled by technology, enabling faster transactions and approvals. Credit became a cornerstone of the modern economic model, relying heavily on consumer indebtedness. Lenders innovated, crafting instruments that disguised inherent risks. The acceleration was abetted by policy changes favoring fewer regulatory checks. Increased borrowing power led to financial precarity for many. Debt tools became normalized in everyday life, embedded in social fabric. Nearly every purchase involved a credit component or loan agreement. Personal debt was often seen as a necessary tool for economic participation. Normalization shifted how society viewed financial health, equating credit use with stability. Credibility became linked to one's ability to manage debt responsibly. Those outside this norm faced challenges in accessing essential economic services. The growth of credit scores epitomized this normalization, rewarding prudent borrowing. Bank statements reflected overburdened consumers with regular repayment schedules. Normalization masked the reality of mounting national and personal debt levels. families adapted by incorporating debt management into ordinary financial planning. Consumer culture accepted this as the status quo. The scale of modern debt is staggering, affecting individuals and national economies. Global household debt stands at an unprecedented $12 trillion. Credit card debt alone tops $1 trillion, drawing billions in interest annually. Average US household debt stands at $145K, just below median net worth. Levels of indebtedness threaten to destabilize economies should repayment falter. Institutions benefit disproportionately from the collected interest on this vast scale. Countries like Greece have teetered under crippling national debt. Regional economies feel the weight of consumer and sovereign debt alike. The scale is both local and international, impacting lives and national policies. Investors are wary of debt-driven bubbles that may burst unexpectedly. The financial system remains heavily invested in maintaining this scale of lending. Power centers driving the debt system are entrenched in global finance. New York, London, and Tokyo House, formidable banking giants shaping policy. Organizations like the IMF exert significant influence on debt-laden economies. Government policies often align with banking interests to sustain the status quo. Legislative bodies face immense pressure from lobbyists promoting financial sector interest. Power rests not just with banks, but with individuals like the Rockefellers and Morgans. Their legacy of leveraging debt for wealth gains persists in modern practices. The power centers orchestrate complex debt instruments with global impact. National governments sometimes find themselves subordinate to these financial juggernauts. Strategic decisions on lending and borrowing shape international relations. The intricate connections within power centers stabilize, yet control financial freedom globally. Points of fragility in the debt system expose serious risks and vulnerabilities. One such point is the reliance on consumer spending to fuel economic growth. A downturn in consumer confidence can precipitate financial crisis. Bank collapses, either from corporate default or systemic failure, pose grave threats. Debt dependency risks, creating bubbles that inevitably burst under strain. Individual financial fragility is exacerbated by job losses and unexpected expenses. Rise in interest rates can increase repayment values, squeezing household budgets. Government debt limits constrain fiscal policy flexibility during economic downturns. The capacity of central banks to mitigate crises is limited by existing debt loads. Cybersecurity threats to financial systems introduce an additional layer of vulnerability. The fragility undermines the stability debt ostensibly provides. Exposure and stress test: how institutions and individuals manage debt pressures. Recent history shows how fragile systems fracture under overwhelming debt exposure. Recessions reveal weaknesses in individual and institutional debt management strategies. Countries like Argentina have experienced defaults with global implications. Economic stress tests assess a nation's ability to withstand financial shocks. Credit ratings agencies gauge exposure levels, affecting countries' borrowing rates. Lenders demand higher premiums for perceived riskier credit markets, just as storms test a structure's resilience. Financial stress tests system endurance. Exposure to debt even impacts investor behavior, swaying markets worldwide. Strains expose weak links in chains of financial dependencies. The ongoing stress challenges the assumption of a resilient debt system. Debt remains influential, shaping present-day financial landscapes profoundly. While many grapple with repaying debt, others capitalize on leveraging it strategically. The cycle of borrowing continues, perpetuating systemic inequities. New generations inherit the burden, but also the possibility of financial literacy. Financial education can empower individuals to navigate debt complexity. Future innovations might revolutionize traditional lending and borrowing frameworks. Why debt persists is partly due to its embedment in economic practices. Countries like the United States demonstrate how widespread debt propels growth. The geopolitical landscape reflects these enduring financial dynamics. Debt is both an anchor and a catalyst for change in modern society. Thus, it continues to shape economic realities beyond the pages of history.